It's been a challenging few years for Australian businesses, and the more data they have at their fingertips to make decisions, the better informed those decisions will be. Today, the CreditorWatch team is delighted to launch the first ever Business Risk Index in the Australian market. The tool is set to become one of the most important inputs businesses have to guide their future planning. This morning, I'm joined by CreditorWatch CEO Patrick Coghlan and James O'Donnell from Open Analytics, who designed the index. Welcome, gentlemen.
Thanks, Ali. Great to be here. Really exciting day.
James, a very exciting day for you.
Oh, very much so, Ali. So we've been working towards this for about 6 months now, so it's great to finally be here.
And congratulations, Patrick.
Yeah, thank you very much. It's been a long time in the making. It's been an idea in my head for a while, and it's been brought together by a phenomenal team. So we're really excited about today.
So I'd now like to hand to Patrick for some opening remarks.
Thank you. So as I was saying, we've been working on this for a long time, and we've really designed the Business Risk Index to be utilised by so many different stakeholders. This is the sort of thing that obviously jumps out for anyone that's in business, that is a creditor, that is looking to expand their business. It gives them that safe insights to understand what is coming in the future, which industries can they target, potentially which ones to avoid, and of course, the most important thing is the regions that they can start to look at and understand how they're working and what to expect. We're looking at over 300 regions across Australia. It's the first, forward-looking insolvency index of its kind. But separate to just businesses, business owners, people in credit and risk, this is the sort of thing that's a game changer for researchers, for analysts, and really importantly, policymakers as well. We've had a huge amount of interest from government of all levels, wanting access to not only the high level information that we're going to look at today, but also importantly, the data behind it, which James will talk to very shortly. So it's a huge win for a range of stakeholders, particularly where we find ourselves. An index is important at any stage of an economic life cycle. However, where we find ourselves today with New South Wales opening up, Victoria due to open up, and the rest of Australia hopefully due to open up to the world soon enough, it's going to be a really, really important index that's released, of course, on a monthly basis, and will be reported on very, very regularly. So extremely excited, and a huge, huge thank you to the team for working on this tirelessly, not just internally at CreditorWatch, across marketing, engineering, analytics, but also, of course, James and his team as well.
So, Patrick, why is now the right time to launch this sort of index?
Look, any time is a good time, but in particular, we felt that with COVID about, with COVID opening up, or hopefully us leaving it behind per se, it's a really important time to provide these insights to help businesses in particular, and especially small businesses who are crying out for any assistance and guidance that they can get their hands on to understand what the future looks like. The big thing that we hear from our customers, we've got over 50,000 customers across Australia, from sole traders all the way up to big four banks, and they're saying it's the uncertainty. So if we can, at the very least, provide a bit of certainty for businesses as to when to open up, industries and regions for them to target or avoid, I think this is going to importantly give lenders as well some incredible insights for them to understand how can they support this growth, how can they support in particular SMEs to open back up, to be able to get going again. We know that businesses can't just turn the lights on Monday and start serving customers regardless of what industry they're in. They need to be able to plan, and planning for the future as well is even more difficult when we're in such uncertain times. So it's a perfect time to launch the Business Risk Index.
How do you think that businesses and other entities are likely to use it?
Yeah, look, I think, as I said, like with multiple stakeholders looking to ingest this information, there's plenty of use cases for them aside from the standard and the most obvious, credit risk indicator. I think, government and policy making is going to be an incredibly important one as well. They can understand which regions really need that additional support. In time, they'll be able to use it as a case study to prove that, investment in a specific industry or region has proven really successful, and we can see that that region's coming out of, being a high risk to a medium risk or a low risk, for example. I think researchers as well to understand how policy has been, whether it's been successful or not, and of course analysts too. We've got banking analysts, we've got financial analysts, we've got these people who really want to get deep into the data to understand, can they give themselves a little bit of a head start when it comes to potentially investing, but also to be able to report on, trends that aren't obvious to the normal economic indicators that we're seeing. I think the other thing importantly to remember is that, we've always reported on, court actions. Insolvencies, of course, has been the biggest one since COVID hit, and payment defaults, credit inquiries, our normal business risk review indicators, that they've become, with the business risk index now launched, somewhat of lagging indicators. We're able to look forward now, and of course they play their part in the business risk index, but as James will show, there's a huge amount of additional data that allows us to look into the future rather than report on the month that's just gone.
And how does the business risk index fit with the existing business risk review?
So we'll still be able to report on insolvencies, the number of court actions, defaults, that sort of thing. Very important, because it's, that is data that we're able to see right now as to how a state or an industry or the nation is performing. They're no doubt very important, and we'll see towards the end of the presentation we actually touch on these. I think what will be important is that, coming out of COVID, if we look, sort of 6 to 12 months from now, when hopefully lockdowns are a thing of the past and we're really back into a normal operating rhythm, we're out of that synthetic environment that's been, synthesized by government, stimulus packages. Those figures are expected to continue to rise, whereas at the moment we see a lockdown happen, and the logical thing should be there should be an increase in defaults and insolvencies because businesses are struggling, but it's not what we've seen over the last 20 months. We see those numbers actually reduce. So you've got to be able to provide better data, and that data that we're capturing and utilizing in the models that of course James and the Open Analytics team have put together is really the key part of the business risk index, and will ultimately, be the more important part compared to the traditional business risk review.
What about governments? How do you expect the 3 tiers of government to use this sort of information?
Look, I think that there's an education piece that's ongoing, and that's sort of started at the moment. What is the business risk index? How does it work? How have you modeled it? How have you proven that the models work? And then they can start to ingest that, understand, all right, we've got these sort of policy decisions to make, or they're underway, or we had this big investment in this area. How successful was it? Where do we need to support either business or people or industry as well? So once they start to get into the data itself, and we're having those conversations with various levels of government and related industries at the moment, that will really start to help them form use cases or business cases for future investment and policy.
Now, we're fortunate this morning to be joined by the Honourable Bruce Billson, the Australian Small Business and Family Enterprise Ombudsman. Bruce, would you like to say a few opening remarks?
Thanks, Ali. It's fab to be with you and Patrick and James and everyone on this call. This is a really important and special day, and a pleasure to be with you. I was fortunate enough to get a bit of a look under the hood about the BRI with Andrew and James and the team that have helped develop this, and it's just a really welcome initiative. A fascinating initiative, Ali. Those insights that we can gain across 300 regions in Australia and across large cohort states in the nation itself all getting a really accurate and up-to-date picture of, I suppose, those financial vital signs that are a really important part of commerce, and particularly so for small and family businesses. Those insights are a vital measure, not just for the economy as a whole, but giving people that tap into the wisdom that's shared through the BRI a closer lens on what's going on in their market, in their economy, in their region. So the timing couldn't be better. We're seeing a few green shoots, or the proverbial light at the end of the tunnel, as more jurisdictions map a pathway out of COVID. I'm coming to you from Greater Melbourne, so we're all optimistic that things will be bright and sunnier very soon. But the states are tackling this in different ways, and we're seeing different pace of recovery. And here the BRI gives us an insight into what's happening and takes that pulse and those vital signs across key dimensions and key data sets. As we're getting closer to that launch day, things are getting less blurry, and clarity and sure-footedness is becoming more a part of the life of so many small and family businesses that I work very hard to support. And so as we see that, relief, assistance, recovery, where to invest, where to seek finance, what are the prospects, what else is going on in your part of the world and your market? These are some of the big questions that are always challenging, but I think with the BRI, you've got another tool to get a better insight and greater clarity about what your next step should be. So that momentum's positive. We want it to continue. There are still some uncertainties out there for business owners and business leaders, so more knowledge and more insight is going to be very helpful. And the BRI gives us a really good view, an accurate view on the health of the economy spread across this vast continent. I think it's going to make many contributions, Ali, and it was great to hear Patrick talking about them. Policymakers, I rate it, I value it, and I know I already tap into some of the insights that CreditorWatch provide. It helps me get a good sense of the field evidence and what's happening on the ground and in real businesses' lives. That's great. But the BRI adds to that with a new tool, and it can make public policy analysis, impact assessment, which economies are doing well, maybe wondering why, and reverse engineering things that are really in the vanguard of recovery and where there might be some slower rates of economic recovery, what that lending picture looks like, who's reaching out for resources to grow and drive their business. These are really important insights, and the BRI gives us a better look at those. So huge and hearty congratulations to Patrick, Andrew, the team at CreditorWatch, to Mitchie. I'm sure she's been central to it. Everyone's worked so hard to produce this index, and I'm really looking forward to seeing the results that coming into my inbox in the coming months and years to come, and also, generating a few thoughts about maybe things I could do to help with my effectiveness in energising enterprises across the Australian economy. So thanks, Ali, for a chance to say a few words. Congrats to CreditorWatch. Great to be at the launch of the BRI. It's a great contribution to the insight, analytical and policy toolkit for our country.
Thanks so much.
Support, Bruce.
Thanks so much. I think it's now time to, as you say, Bruce, get under the bonnet and ask James a few questions about the index itself. So what actually is the Business Risk Index?
Yeah, so Ali, the way I like to describe the Business Risk Index in a way that's easy to understand is as a regional credit rating. So you'll tend to think of credit ratings associated with individual businesses, and they measure the credit quality or default risk of an individual business. The BRI is really a credit rating by analogy for an entire region. So it measures the average credit quality or default risk of a region. As has been mentioned a few times, we've developed it at about 300 different regions across Australia. For those technically inclined, we've aggregated to a SA3 or statistical aggregate 3. To give a sense of that granularity, there's about 300 SAs in Australia, and within big city centres like Melbourne and Sydney, there's about 40 to 50 of these regions. So it's quite granular. The population base behind it, we've calibrated the model on about 1.1 million credit active regular PTY LTD businesses. So that's the population. Then just to describe the numbers behind it. So fundamentally, it's a PD or probability of default measure. So what that means is that we're looking at the regions, and we're measuring what's called a probability of default, which is essentially what we expect in terms of the percentage of businesses in that region that will go insolvent over the next 12 months. So you can sort of see in the graphic on your screens there, sort of what we do here is we assign the PD to each region. Then to produce the index, what we do is we rank those regions from best to worst. And then we put that on a simple to understand sort of decile or percentile scale. So to interpret it, it's basically if you get a rating of 100, you're basically the lowest risk region in the country. Then at the other end of the scale, if you get a rating of 0, you're the highest risk. So if you're getting an index around 50, you're around the median. So that means if you're exactly 50, that means half of regions in the country are better than you and half are worse. So a normal sort of index will be in that sort of 40 to 60 type range. You can see just on the screen there, just a bit of a visual there that shows the default rates in sort of 10% groupings. And in a practical sense, that's how we think this should be used. So you can sort of see from left to right, the bottom decile, or sort of the worst 10% through to the best 10%. And what we tend to see is that sort of regions that we place in that sort of bottom 2 deciles or even sort of the bottom 3, so an index of either less than 20 or less than 30, they'll be reliably quite high risk regions. Now, importantly, the data that feeds into the index. So there's a broad range of data that feeds into it. And essentially, we're using the machinery of CreditorWatch's rating system and turning it on the whole country. So there are fundamentally 2 types of data sources feeding into the index. So number one is the CreditorWatch data assets, and that's real sort of dynamic real time. We're essentially credit rating each business every day. Some of the key, probably the most significant dynamic factor there is CreditorWatch's B2B transactional data. So we're capturing things like payments and turnover for about 1 million businesses across Australia. And the best way to think of this, we're essentially pooling all that data and generating an average rating within each region, so rolling up from the individual business level to the region. Now, importantly, we're combining that more dynamic data with more sort of structural economic factors that we've included these because we think they're quite intuitive. And when we're sort of talking to economists and other people, it helps sort of describe some of the underlying drivers. So just to call out a couple, a key one sort of the structural drivers, the most significant is actually turns out to be property costs and commercial rent prices. So I think for anyone who's run a business that would probably ring true that. And what you do tend to find is in some of the big sort of city centres like Melbourne and Sydney, those really high commercial rent prices put a lot of pressure on businesses. The other sort of broad sort of types of factors tend to relate to measures of economic opportunity, wealth, so measures of essentially the wealth and economic resources of the region. So once we've built the model, of course, the most important thing is to backtest and make sure it works. So the backtesting that sort of on the next slide, Pat, if you want to flip that through. So this chart sort of gives a sense of how we use it ourselves, and we hope sort of customers will use the index. So what we tend to do is sort of group into broad groups, say either 10 or 20% groupings. What this graph shows is a bit of a time series of default rates against some broad groupings of the index. So if we go from top to bottom on the chart, the red line at the top there is the highest risk 20%, and I'll talk a little bit about what sort of regions are in there a bit later, through to the next sort of 20% all the way through to the top performers. So you see that quite good spread over time. And you sort of see compared to the average, which is that sort of middle dotted line, you get quite good spread in insolvency rates. Just to illustrate that a little bit further on the next slide, if we sort of pull out the real sort of top and bottom performers, so you can sort of see that spread across the guys that we're giving an index of 0 to 10 versus sort of 90 to 100. So those, when we put regions in these groups, they'll reliably have quite high or low default risk.
So James, tell us a little bit about what the first iteration of the index says.
Yeah, there's actually a lot to say on that question. So there's actually preparing this presentation was quite tricky because we had just so many different individual case studies and looking at individual regions. But look, I'll pull out a few sort of key themes. So number one, we're seeing sort of regional areas outperforming urban centres and cities. That seems to be a trend that's happened really sort of since COVID. The second point is we're very much seeing deterioration in the major city, the eastern seaboard CBDs. So particularly sort of Sydney, Melbourne, and Brisbane. Not so much in Adelaide and Perth and some of the other regions. There's two significant sort of hotspots in terms of high risk. So number one is the Gold Coast. So that sort of tourism-driven industry region in Queensland is faring pretty poorly, but both long-term and has got worse during COVID. The other big one is sort of regions around Western Sydney as well, and I'll give you some more examples of that shortly. Now, there's actually a lot of positive news. So we're seeing a lot of regions actually holding up quite well. So there's definitely a theme around agribusiness-driven regions. So places like Mackay in Queensland, with sort of the sugarcane sort of capital of Australia, the wheat belt in the WA, a lot of the wine regions like the Yarra in Victoria, they're actually seeing improving credit scores, lower defaults, and actually looking quite good. The other one, sort of manufacturing regions, tend to be outperforming the rest of the states that they sit in. So we've got some case studies around Geelong is a good example, where Geelong, the big sort of manufacturing hub in Victoria, is performing quite a bit better than Victoria in general, but then also certainly performing better than sort of urban areas around Melbourne. And look, the last point there is more of a sort of macro point, is that we are still seeing the positive impacts from all of the various policy intervention. The government sort of support through JobKeeper, and then also a lot of leniency from creditors. So we know, working with the banks are still giving quite a number of payment holidays, and then of course the ATO is relaxing their sort of enforcement of tax arrears. So we actually are still seeing the default rates are fairly low, but we are expecting those to snap back to where they were before COVID over the next 12 months. Just probably a bit of a visual here. I thought of different ways to visualize all of this data. What this graph shows, it's what's known as a bubble plot. So I'll just take a bit of time to explain what it is and then use it to call out some examples. So on this chart, every dot on the chart is one of those 300 regions. The size of the bubble is correlated to the number of businesses within the region. So you can see a few names on there for illustrative purposes. So obviously you can see Sydney is the biggest bubble there. Now the vertical axis captures the default rates observed in that region over the last year. So that's sort of the backward-looking view of what we saw last year. The horizontal axis is our forward-looking prediction of the future. So that's what the index is based around. So basically, as a region, you want to be further to the left than the right. So, and those sort of regions in that top right-hand corner, that basically means they've had higher default rates recently and expecting to stay there. On the next slide, sort of calls out a few of the points that I made before. So something that really stood out to us, if we look at the top 10 highest risk regions in the country, they're all in New South Wales and Queensland, and specifically they're all in the Gold Coast and Western Sydney. So it might be a bit hard to see some of the names on the screen there, but places like Southport, Oxenford, Coolangatta, regions within the Gold Coast, all of those Queensland regions are within the Gold Coast Shire. Then the other regions are Canterbury, Bankstown, and sort of surrounding suburbs around there. So we're definitely seeing very high, and particularly in the Gold Coast, we've seen sort of relative to the rest of the country, quite a bit of deterioration. The next slide sort of shows, if I filter the data down just to larger regions, so same data, but I've filtered it down to regions that have at least 5,000 credit active businesses. So the first thing to sort of call out here is that the capital city relativities. So we sort of see that eastern seaboard is sort of clustering around that, the CBDs on the eastern seaboard, clustering around that sort of 6% forward-looking sort of PD. We're a bit more pessimistic on Melbourne than Sydney at this stage, and that's driven by we're seeing quite a drop in credit scores and quite an increase in business-to-business trade payment defaults, so businesses registering defaults against each other. The other flip side, sort of Perth and Adelaide actually performing quite well. So the other sort of general theme that I'd pull out is if you compare some of the regions like Newcastle, for example, is performing quite a bit better than Sydney. Geelong, the example I mentioned before, regional sort of manufacturing area, sort of quite a bit better than Melbourne. So yeah, there's some of the general themes. Now I'll finish with one sort of point at a macro level, what we're seeing across the economy in terms of trade turnover. So we're seeing sort of trade receivables on the next slide there, Pat, if you want to flick that through. So at CreditorWatch, we watch this statistic quite closely. It's a measure of, we roll up all of our data suppliers and we're capturing their trade receivables. So big, huge pool of data. And we measure a growth on trade receivables per data supplier. So what this chart measures is the trade receivables of all of those businesses added up and what that looks like compared to the same time last year. So where that number is positive, it means basically higher turnover. Businesses are doing more business than they were last year. They've got more, higher receivables. And you can obviously see that sort of the period where JobKeeper was in place, you can see that big contraction. So essentially JobKeeper was there to fill that hole in some respects. Now, we were at the time, right when sort of JobKeeper was being switched off, things were actually looking quite good. Like the trends were going in the right direction. So of our data suppliers, we could see they were doing more trade and those receivables were starting to get back to normal. But then of course, Delta hit and sort of things have sort of gone south again. But as sort of Bruce and Pat said towards the beginning of the session, we are opening up now. So we're actually quite hopeful that trend will reverse and we'll start seeing that measure start heading north again.
Yeah, it's amazing. You can really see the impact of Delta and also the impact of JobKeeper. So I'm going to throw to Patrick now to talk about the latest default and payments data. I can see there's lots of questions coming through. Thank you so much. We'll get to them after we talk to Patrick about default and payments data. So over to you, Patrick.
Thanks, Ali, and thanks for that, James. Awesome insights as always. So look, back to our sort of traditional business risk review, stats and data that we would show. We're certainly not forgetting about it. It's certainly got a very important place in our monthly release. So the probability of default by industry, probably no real surprises here. Of course, with food and beverage services at the worst of the industries by PD. This will be a really interesting one to watch over the next 3 to 6 months, but probably even in the shorter term to see how quickly that turns. We know that plenty of people want to get out and about. I'm in Sydney. I was at my favorite cafe at 7:15 on Monday morning, having a coffee and a breakfast while sitting down. So I wasn't the only one. There was lines at most restaurants and cafes, and I think that's a really good sign. It's very difficult to get a booking anywhere as well. So for everyone in that food and beverage sector, hang in there. There is a big turn coming, which is good. The second one there, arts and recreation, again, probably no surprises. And then financial insurance services rounding out the top three. The good thing about the financial insurance services, the data coming out of the bank suggests there isn't, a huge worry in terms of, payment holidays and people on hardship programs and whatnot. And you can see stretching all the way to the middle, there isn't a huge amount that separates, say the top 10 from 3 to 10 rather. At the opposite end of the spectrum, you can see some really high performing industries, and James talked about these: mining, ag, and of course healthcare as well. It's got back on track after they sort of struggled, in the middle of last year and towards the end of last year. Our three best performing ones, and of course, I think that the best story of COVID is the success of manufacturing. Everyone was saying manufacturing was dying or dead, depending on who you spoke to in Australia, and that's certainly not the case. It's had a miraculous turnaround, which is fantastic to see. The next one we've started to recently report on is payment arrears by industry. So this is looking at the proportion of businesses that are paying 60 days overdue within a specific industry. Number one here, construction. You know, even pre-COVID, we know that, you know, the construction industry is notoriously slow. We're hearing more and more about, you know, payments being withheld, and that's a combination of projects, you know, taking a lot longer to actually be completed. There's the knock-on effect of supply chain issues, and of course, progress payments from lenders as well. And then the other two rounding out the top three: accommodation, food and beverage, and transport, postal and warehousing. And that one has been at the top as well for quite a while. You forget about the Afterpays and the Coghans and the e-commerce of the world, and remember that, you know, Virgin and Qantas sit in transport, and of course then there's trains and buses and whatnot as well. So there's been a lot of pressure on that industry from, you know, the first day that, you know, COVID really started to kick in and become a common word in Australia. Again, at the opposite end, the best paying industries at the moment: healthcare, social assistance, which is fantastic to hear, agriculture, and education and training, which is an interesting one. As the borders start to open back up, we know that industry is crying out for international travel. From a credit indicator perspective, credit inquiries remain flat despite, you know, building over the first sort of 6 months of the year. Of course, COVID hit and that slowed it right down, and that's looking at, you know, that B2B trade, that is businesses applying for credit, whether it's finance or trade credit, and of course suppliers performing checks on those businesses, either prospects or existing customers. From an external administration perspective, there was a 23% reduction for the September quarter after a peak in June, which was the highest level since March. We're expecting that to probably remain flat for some time. It'll be interesting as we start to open back up. Big question mark is obviously when will the ATO and the big banks, of course, they're by far the biggest creditors in Australia, when will they get back into their normal collection rhythms and start to wind companies up? So we're probably not expecting to see that until mid next year, towards the end of the financial year. Court actions fell again until there's, you know, a real open society. That's going to be at record lows, and they really need to get through quite a backlog. Payment defaults, you know, talking about a lagging indicator or a false negative, or false positive rather in this case. You know, defaults fell in the September quarter despite businesses arguably, you know, being in a worse position financially for quite for forever, or for on record for CreditorWatch at least. I think the important thing here to remember is that we know that creditors, particularly in Australia, are extremely sympathetic to their customers, to their neighbours, and they don't sort of jump on them when they're in tough times. There's a lot of payment plans out there in that trade credit world, so we will see how this changes over the next, you know, 6 to 12 months. So look, it's certainly not negative. James touched on plenty of positive insights that we're seeing, and I think we still find ourselves in a much better position than anyone anticipated. Of course, very different to where we were in May and June. However, the fact is, we know that light at the end of the tunnel is coming very quickly. It is, you know, if you're in Sydney, it is in your face right now, and people are starting to get out and about and spend their money and get back to a normal sort of, you know, commercial rhythm, which is fantastic. And we know that, you know, Victoria, in particularly the second biggest state, very, very reliant on it from a national perspective. They won't be far behind New South Wales. So really good news about that as well.
Yeah, certainly. You know, I certainly hope we follow the overseas experience where things have seemed to pick up pretty strongly after lockdowns have ended. So we've got quite a few questions to get through. The first one is the BRI system also drilling down to business segment and by customers known to CreditorWatch?
So I might jump in first there, James. So I think what's important to remember is that the data that's being utilised to create the business risk index is the same data that is used in our credit reports on individual, you know, companies and businesses, particularly aligned with the risk score and credit rating that we have in there. So yes, while you're able to look at the business risk index and say that, you know, the Gold Coast, for example, is one of the riskiest regions in Australia, you could then go and look at a specific company, specific credit report on a business that exists in the Gold Coast and understand exactly what sort of risk they represent from a credit perspective, and see their risk score, their risk rating as well. So yes, you can drill all the way down into individual businesses, and the data behind it and the models per se are very similar to what we're seeing from a business risk index perspective.
The next question is about key insights. Key insights are important, but we also need to understand the why and the rationale. So why are regional centres outperforming cities?
James, do you want to take that, or do you want me to start?
There's a few reasons. So some of the indicators that we're seeing, a key one is actually that commercial property prices. So we're seeing that, okay, everyone's turnover is lower at the moment, but you can survive kind of a low turnover year a lot better running let's say in the Adelaide CBD, where the rents are probably circa half what they are compared to Melbourne or Melbourne or Sydney. So that's one factor. Then there's different factors within different regions, to be frank. So we're seeing, in general, we're actually seeing the average trade payment defaults are down, but they're sort of up in some of the key cities of the Gold Coast, but some of those regional areas, the level of trade payment defaults have actually gone down quite a bit. So yeah, I mean, in terms of economic drivers, I personally tend to think the commercial rent cost is a really significant factor.
And the other thing is obviously lockdown as well. You've got Adelaide and WA in particular who have remained fairly open.
A question for Bruce. Bruce, do you expect the economy to, go gangbusters once things do open up again?
Oh, I think there'll be a definite uplift, but something I've seen in Melbourne, and I'm coming to you from the city, I think I'm on day 255 of hard lockdown. So, and it's the sixth version of it. And I think some of the data that James has actually shared with me and Patrick have shared with me has shown that after each lockdown, the bounce back on the other side's not quite as buoyant as the time before. So I expect, yes, there will. See, James, I do pay attention, sir, to your data, but and your analysis, and Patrick. So I think what we're going to see is, yes, a bounce back, and I'm really encouraged by what we saw in Sydney. That there's a real cautious optimism there. I'm picking that up elsewhere. I don't think it'll be quite as bold as lockdown 1 or 2 as it was in Victoria. The other thing to watch, though, is supply chain issues. It's hard to get staff. Staff have relocated, changed. Migration's having an impact as well. So that the labour force, both skilled and unskilled, I think might be a little bit of a break. Not a negative, but just slow it down a little bit. And getting stuff through the wharves and supply chains, I'm seeing that popping up in a number of areas now as a bit of a break. So there's an opportunity for forward orders, but people are worried about fulfillment because there's uncertainty around supply chain. So that's my observation. Yes, a bounce back might not be quite with the vim and vigor that we saw previously. It'll still be there, but there are some, let's call it handbrakes on that recovery in my eyes. Maybe James, Thanks. You can correct me if I'm misguided on any of that.
No, that makes sense to me. I'd say I'm generally optimistic after looking at all of this data. That there's as many good stories as bad ones, and maybe to add to that previous question, that certainly in the agribusiness industry, that definitely seems to be a key factor. I mean, I sort of mentioned the sugarcane capital and the wheat belt. I think we're all sort of sitting down in lockdown eating a lot of carbs, so those regions sort of really stand out. So, and I think there's also been population movements, like people. There's actually, there's more startups. Another stat that we didn't show, the sort of number of sort of startups in Melbourne and Sydney has really gone down, but in some of those regional areas, people are actually moving there as well.
Well, I was going to just touch on that quickly, Ali. It's been a renaissance of entrepreneurship almost, where you look at new business formation startups, the numbers are quite stellar. Now, admittedly, some people would have done that because they'd had to. Remember the first lockdown, a lot of businesses started laying off non-core people. They're usually highly skilled, highly sought after. They've gone out and maybe stayed involved as a contractor, but some others in the industry have thought, I'd like a piece of you too. So there's been a little bit of that going on, a little bit of a flight to the bush and the beach in terms of population movement, and James has touched on that. The two things to watch, we are way down on insolvencies, and I suspect there'll be some adjustment and cleaning out of that. And that'll be tough for small business owners when they look at their P&L and particularly their balance sheet, and see some of deferred financing or arrangements with tenancy, leasing, all those sorts of things now coming home to roost, and then imagining what recovery looks like with that extra lead in the saddlebag. That's going to be a bit challenging. And as James and Patrick pointed to before, as support comes off, we're going to have to be really supportive of people that might have a really tough reality check looking at their prospects going forward.
It's almost a tale of two cities. There's opportunity, and then there's a lot of people who need some help. So the next question I think is probably for James. How often are you planning to update the model to accommodate economic data shifts?
Yeah, so well, the answer to that is monthly. So we're going to be we update the data sort of monthly. Our credit rating of individual business is actually more or less real time, so more than daily. But we're going to release the index where all the factors I spoke about will be refreshed. Look, I'd say some of those structural drivers though are on different sort of time scales, so they don't tend to. I didn't go into the nuance there, but they're actually rankings of each of those measures, so that the rental cost is actually a relative. They tend not to move drastically. They do change, but over sort of multi-year sort of timescales. So in general, those economic drivers aren't the kind of real drivers of the big shifts. That's more the CreditorWatch transactional data.
The next one is a sort of similar question. Can you run the BRI in certain industries in the regions?
We haven't done that, but yes, we've got the data to look at that. And look, I should say we've spoken to a few customers that we've given previews to. I think there's a lot of interest in actually looking at how creditors' portfolios look against the index. So we can cut it by many different sort of data elements, and including industry.
One of the challenges has been picking what to actually show, right? Yeah. So we could have done a presentation with 50 or 60 slides and still left things on the cutting room floor. So it's a great position to be in.
And folks, it actually looked like what was going to happen, and we were so jazzed about it, but we were worried it might put you to sleep. So taste teaser, good call, Patrick and James and Ali, keeping it focused on some high-level insights, but there's much more to be gained when you peel back the layers of the data and the analytical frame. That's one of the reasons why I think the team at CreditorWatch have done a great job with this.
Yeah, the volume of data is just extraordinary. So another question, how would you validate the turnover forecasting? Would you have access to financial reports like profit and loss and balance sheets? Good question.
Yeah, okay. So for the turnover is an important sort of factor in the rating system, but we're not forecasting the turnover. So we're using the recent turnover to forecast the credit risk. And that's sort of the same as sort of all the factors in the rating system. So, unfortunately, we don't have access to accountants' turnover forecasts, but so the simple answer to that is we don't.
So just to be clear as well, so with the collection of trade receivables via age trial balance or accounting software integration, we're able to see an individual business's turnover, but also see the spend against specific debtors, and that's how we're able to create payment ratings and various other insights. So that's ultimately where we're getting that data from.
Also, another sort of input question, what are you relying on for geographical insights? Is it businesses' registered addresses?
Yeah, it's the main physical registered address for the business is how we sort of pinpoint. And look, I should say for this type of measure, it's really suited for that SME sort of market, the middle market to small business. What you'll find is, I wouldn't use it to assess a big multinational, or some big businesses have multiple site locations. So we're using the main physical address, and it is targeted more at the SME end of the scale.
Right.
And we're aware that from time to time there is the accountant's address used, but we look closely at this, and 98% of the time that it's spot on as to where their registered physical address is.
And I guess, Ali, for the audience, those really interested in that, there's a modernisation of business registers going on at a Commonwealth level, and it's trying to unpick some of that. As James and Patrick have alluded to, sometimes it might be the accountant or some point for the delivery of notices in the formal sense of the word, and so hopefully that data set will improve over time as well.
Is the BRI incorporated into company credit scores, or is it a separate measurement?
The answer to that is it will be soon. So in the current credit rating system, we are using some individual location risk measures within the rating system, but we're going to basically integrate this new factor into the new rating system, which we'll be releasing sort of later this year, early sort of next year.
Watch this space. Might there be some unexpected consequences where specific regions are somewhat labelled more risky, referring to the availability of credit for businesses in those risky regions?
Yeah, this is an important question. I might dive in on this. So we hope it's not. Our intention is not to use this measure in some ways that other sort of indexes are used in terms of like blacklisting suburbs. So look, it's a tool, and this is all about sharing data. We would not sort of recommend, like, take the Gold Coast, for example, right? So yes, the Gold Coast is higher than average risk. We're predicting a sort of 7 to 8% insolvency rate. That doesn't mean there aren't plenty of very profitable, very good credits in the Gold Coast. So it's a tool to be used within a full credit assessment. It doesn't override looking at a company that's good profitability, good good interest coverage, and other sort of factors. So our intention certainly isn't to create a blacklist, but yeah, I guess I'll leave it there.
A question from our own Chief Economist, Harley Dale. The economic recovery will be uneven. Is that where the BRI provides a key insight over the next 12 months?
I think the answer is that yes. Pat, do you want to jump in on that and say anything?
Yeah, definitely. So I think, as I touched on and James mentioned as well, this is a forward-looking index, and as far as we've found, or we haven't found, that there's nothing else out there like this. So that's certainly giving you that future insight into what to expect at a national, state, industry, and regional area as well. So yeah, it's definitely giving us that ability to understand what it looks like in 12 months. And of course, there will be adjustments along the way as there are bumps and hurdles. But yeah, definitely a yes from me.
A related question, does the forward expected default risk factor in expected reduction winding back of government support for New South Wales and Victoria coming out of lockdown?
Yeah, I think that there's probably a couple of ways to answer that. So what we're seeing currently in our rating system is, if I look at it, what's the implied default rate compared to what's actually happened, a big gap has opened up. So the way I would characterise it is our credit scores across the country have actually deteriorated over COVID. So we're predicting a level that's quite a bit higher than what we're seeing. We're effectively expecting the actual default rates to snap back to roughly what our credit scores are implying. So in terms of a quantum, we're expecting sort of the insolvency rates over the country to go up by about 1%. Now, our model isn't magic, so we don't know how quickly that will snap back. So I think that there's certainly some uncertainty there. What these models do, they're very good at sort of rank ordering, if you like, sort of ordering regions, so we know which ones will be the highest risk. How big will that peak be, and how quickly will it come back? I'd say our model won't tell you that, because it depends on so many sort of big levers that the government and banks and others are holding. But things are looking good. We're optimistic. I mean, I think from the data we've seen, we've probably formed more of an optimistic view than when we started. So that we're not seeing really bad deterioration in credit scores anywhere that's really alarming. So in general, I think it'll insolvencies will snap back by about a percentage point. But then it's sort of, will that be in the next 6 months or 12 months or 18? That's hard to tell.
I think also on that is, everyone needs to expect defaults and court actions and insolvencies to go up. That's ultimately what James is saying. But because they're going up, it doesn't mean it's worse, right? We need to get back to those normal levels or close to those normal levels, right? And we are still well down if we just use insolvencies as a yardstick.
Bruce, from your perspective, how important have the government stimulus packages been in supporting businesses and family businesses?
I think they've been vital, absolutely vital, and I think the data proves that out. But even the field evidence proves that out. I mean, the number of businesses that have been able to keep a pulse, stay engaged, keep their staff, support livelihoods, staff confidence, optimism about the future, then seeing those resources generating further economic opportunity throughout the economy. So it's one thing to provide that support, but then the business or individual then uses that support, that then puts some wind in the sails of those that they're placing their dollars with. So I think it's been absolutely crucial. There's still some scope for calibration. We're moved into a different phase now where after the initial economy-wide measures, then it became a state-by-state, jurisdiction-by-jurisdiction thing, and that was a split funding arrangement between the feds and the states. I think some of those measures have been better in some states than others. I think the New South Wales use of a percentage of turnovers probably landed a bit better than some of the measures in other states. Measures to get money out the door. So, I've seen some commentators a little bit critical that, not everyone's been a rolled gold candidate for the benefit, but may have received it. There was precision I suspect, a little bit of a victim of pace, and pace mattered. So, I'm not critical of that either, but I think that's very important. I guess the message I've been trying to provide policymakers is, as we come out, let's not just think the whole world's going to change overnight. We all on this call know that, with an aircraft, it's never burning more resources and testing its system and its people than when it's trundling down the runway and hasn't even taken off yet, and you're not sure what the trajectory looks like. So the idea you should just turn it off completely, I think, is misguided. But there'll be a need to recalibrate. And then there's still, the prospects we might, COVID-6 lockdown in Victoria, heaven forbid, we might need some kind of targeted measures into the future as well. So, but those supports, the government's to be given great credit. I used to be a cabinet minister in the Treasury portfolio. I can't begin to imagine the kind of conversations that surrounded this behemoth and incredibly courageous policy decisions that has really stood us in good stead and gives us every possibility for a great lift off. I share James's optimism in that respect.
Yeah, it's been an incredible level of support. So a couple more questions before I hand back to Patrick. What are the major segments that you have in your analysis, i.e., is that SME, medium or large businesses or all sizes of businesses? I think you've touched on this, James.
Yeah, look, in the calibration, we've basically put in all businesses, but I'd say that the sample is enormously skewed to smaller businesses because 95+% of businesses would be regarded as a small or SME.
I'll just, sorry, Ali, just to add to that, at the end of the day, CreditorWatch is, we've got 50,000 plus customers or companies using us, and they are of all sizes, right? Sole traders through to big banks. So the data that we collect from them is ultimately feeding through into the reports and also, of course, into the index.
A related question, really. Will you be able to break out companies, trusts and partnerships per region in the future to see their risk factors? Good question.
Yes. The simple answer to that is yes. We've got the data to do those splits, and as I said before, where every day we think of a new a new way to cut the data, but we can essentially cut it by those dimensions. Yeah, but haven't yet.
James and Patrick, was unwise having me on this call. You know, I've had so many of these ideas about how to slice and dice the data, and there's more now. This is fantastic. So whoever had that question, thank you for just feeding them through. I stalked the team at CreditorWatch to see what sort of other insights we might be able to extract out of the data they have access to. So thank you for that questioner.
Now I'll throw back to Patrick for some closing comments.
Thank you, Ali. A big thank you to Ali as well. She's put a huge amount of time into this, not just being a fantastic host. So thank you, Ali, for the efforts. James, of course, a big thank you for the amount of time, emails, phone calls, and ongoing, you know, media commitments and presentations. This is the first of many that you've already done, and the first of many to come as well. It's a fantastic index presentation, as we've touched on. I think gets to the heart of what we're trying to do. There's plenty more to come, and of course those suggestions coming in from our attendees and anyone else that we presented to, they're certainly not being forgotten about. You know, this is anyone who knows CreditorWatch, we don't stand still. We're extremely dynamic, so there'll be plenty more to come of this. And of course, Bruce, a huge thank you for not only meeting with us regularly and challenging us in the most positive of ways, but also for making the time today to be our guest contributor. And we always love your company. So thank you for that. And look, as a final few words, we've just been chomping at the bit to release the index, and it's amazing that we're finally here. And I can't say enough to thank everyone at CreditorWatch and Open Analytics and those partners that we've met with and presented to and got them to challenge us and think about different ways of doing it. It's a hugely momentous occasion for CreditorWatch, one of the biggest days for us in our somewhat short history. I'd encourage you all to jump onto the website, creditorwatch.com.au. There should be a link on the homepage there. If not, creditorwatch.com.au/business risk index. There's some phenomenal interactive maps. And if I can go to webinar to be supportive. Oh, there we go. Fantastic. I love it when technology works. Jump on here. You can see business/business risk index. You can actually start to jump in and have a look at those regions. So there's I guess a voyeuristic nature to this as well, to have a look at maybe, you know, where you're located, where your business is located, customers, etc. Jump in and have a look. You can see by region, you can see by state, you know, by just hovering over the top. This will be nice and competitive. I know at CreditorWatch between Victoria, New South Wales, and our Queensland brethren up north. You can see the national receivables growth. Hopefully we start to see that go in the opposite direction in the next 12 months. And of course, probability of default by state, and importantly, by industry. So please, I encourage you to jump in there, have a look at all the information that you can handle. And there's plenty more information on the blog as well, because there's a number of articles that have been released. Bang on 12:30. We set aside an hour. Thank you all so much for your time, for taking the time out of your days, for your patience as well. As always, please don't hesitate to contact us if you've got any questions or any feedback. But until then, stay safe and hopefully see you in person very soon. Thank you, everyone.